Welcome to the Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
And happy Sunday afternoon, everyone. You're listening to the Real Estate Show. I'm your host, Terry Kilakos, chartered real estate and mortgage broker, as well as president of Northeast Real Estate and Mortgage Agency. And today we're talking about refinancing your mortgage and why now is the best time to do so. Joining me, we have my co-host, Merav Marciano, chartered real estate and mortgage broker and vice president extraordinaire of Northeast. She's actually not in studio with me. She's in the comfort of her home because it was too cold for her to leave the house today. Right, Merav?
Yeah, right. Yeah, we're being COVID safe, you know.
There you go. There you go. And for everyone that's following us on Facebook right now, you just have to kind of you're gonna see Merav kind of at home, and you're gonna see me here in the studio, which is kind of bizarre, but it works. Whatever works, right?
Exactly. Sorry, I'm like getting used to this technology.
It's all good. It's all good. We'd love to hear from you, so feel free to call in with your questions to 514-790-0800, or you could text into 514-800. And don't forget to write your name in the text so that we can give you proper kudos. You can also watch us and comment on Facebook Live at facebook.com/Northeast or Nordest. Actually, it's Northeast, Nordest. It's both. And please be sure to subscribe to our YouTube channel, which is News on the Go, where all the fun and exciting stuff that we're doing right now is going to appear live. So, Merav, this week, it's been a little bit of a crazy week. Bank of Canada meetings, monetary policies, CMHC making announcements. Let's talk about everything that's basically been going on.
Yeah, absolutely. It's been a little bit crazy. I could say crazy is an understatement. Again, the real estate market is absolutely insane. I find now that the market is reopening up and we see a lot of multiple offers, things like that happening. Once again, I find there hasn't been really a slowdown except for over the Christmas holidays. But now basically we're going to start seeing our buying season start up again. Now, with respect to Bank of Canada, Terry, what did we see?
Okay, so first and foremost, I mean, the Bank of Canada did not lower the overnight rate, which some economists thought that they would have. Like we talked about it last week, we said that they might go in with a small decrease. They didn't do a decrease, which is fine. I mean, as far as I'm concerned, it's... I think 0.25 is pretty solid. So they kept it status quo. And they also said that they would not be raising the overnight rate until 2023 or until we reach inflation at 2%. So right now, the Bank of Canada is hovering. The inflation index is around 1%. So we still have a little bit of ways to go before we're going to be seeing any increases in the overnight rate. The other thing that happened was the Bank of Canada said that they're going to start buying out those bonds again. And you made a comment, Merav, you said that it was $4 billion per week that they were looking to buy?
Yeah, $4 billion per week right now.
Wow.
Of Bank of Canada bonds. Bank of Canada is purchasing Canada bonds in the rate of $4 billion a week. And that's really to stabilize the economy in order to lower the cost of borrowing for Canadians. So I think we're going to be seeing reasonable rates for a while, and we're not going to be seeing the overnight rate go up anytime soon. Definitely for another 2 years, we're foreseeing it to be low, which means variable rates will be low, and our prediction of fixed rates possibly going up might be delayed, seeing as Bank of Canada started buying up those bonds again.
Interesting. Very interesting. Now, the grim forecast that CMHC made. Okay, so let's talk about what's actually happening in the mortgage market. Okay, so in the mortgage market, we've seen, not the mortgage market, excuse me, in the housing market, we've seen a crazy increase in house prices. They just keep going up and up and up. But yet CMHC is saying that the prices are going to actually be dropping. And they said that they can drop as much as 50%.
Yeah, we're actually very surprised about that, and I think our prediction is that CMHC might be trying to cool down the market, especially in Toronto and Vancouver. It's almost like they're encouraging people to not purchase real estate anymore. It's their way of cooling down the market, which feels a bit wrong, because Bank of Canada's prediction is that the real estate market is going to slowly um, taper off, but CMHC's predictions are way too grim and way too intense.
Wow, interesting. I'm looking forward to seeing what happens. And the thing that you have to remember when CMHC makes announcements, they're making announcements based on the entire country. Okay, so they're looking at the Vancouver markets, they're looking at Toronto, they're looking at right across the board. When you look at Montreal's housing market, although it's actually gone up, when you compare it to Toronto and Vancouver, it's nothing. I mean, it's so yes, maybe we're going to have some corrections in those markets, Vancouver, Toronto. I don't think that's going to be happening in the Montreal market. As a matter of fact, what I'm actually seeing is an increase, right, in the demand, but a decrease in the supply. Correct? I
Yeah,
mean,
I absolutely agree. Definitely, we're continuing to see the trend of increased demand, reduced supply, and yes, it will slow down a little bit, but I definitely don't foresee a crash. Montreal, especially, is not at the point of creating a crash. Maybe Toronto and Vancouver will be a much bigger adjustment, but not to the tune of 50%. Definitely not.
yeah. We actually have a question online on Facebook, and it's related to refinancing. So I'm going to hold off until after we come back from traffic for that. Okay. But let's talk a little bit about today's show. And today's show is going to be all about refinancing. So, what does refinancing actually mean? Right? A lot of people have this misconception about it. So people will come in, they come to the office and they say, I need to borrow some extra money on my mortgage. And I say, would you like a refinance? And they are like, no. And I'm like, well, that is what a refinance is. So now with interest rates being so low, it is actually a really good time, which we're going to look at in a little bit more detail. But what are some of the misconceptions that you've seen about refinancing, Merav? Have you seen people kind of...
Well, definitely. I think back when we were growing up, saying remortgaging was considered something very negative. Nowadays, I think we're all much more, I won't say educated, but aware that refinancing could be a good strategy to improve your cash flow, to get money out,
Sure.
and to get all kinds of tools and strategies that can actually increase your net worth and increase your monthly cash flow in general. So I think that it's important that we inform the public what refinancing means.
And this is not to be mistaken by switching, right? So a lot of times people think that refinancing and switching ends up being the same thing. So when you come in, let's say, and you want to restructure a mortgage so that you can have an actual lower interest rate because interest rates are so competitive right now, that's not the same thing as refinancing. If I take you dollar for dollar, amortization for amortization, so let's say you started off on 25 years, you've done 2 years, you've got 23 years left. So that's amortization for amortization. You owe $321,500, and I transfer that from one institution to another for a better rate. That's a switch. And even with switches, I'm actually able to increase it a bit, which we're going to talk about that in a second. When we come back, we're going to be looking at today's market conditions and why now is the perfect opportunity to renegotiate your mortgage.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're talking about refinancing your mortgage. Feel free to call into the show at 514-790-0800, or you could text into 514-800 in order to share your experiences as well. If you're watching us on Facebook, it's actually quite comical because Rob is having some technical difficulties. I'm having technical difficulties on my side. So this is quite entertaining, right, Rob?
Yeah, absolutely. Lots of fun. It's our first time doing it remote like this. You're at the station, I'm at home, and definitely trying to figure it out. We're technology we're good with technology, but this is a bit much there.
You know what? The one thing I've realized is I don't take myself very seriously. So this is perfect. If I took myself serious, this would be bad, but it's fun. I love it. Okay, so let's dive into the show. Okay, so we talked about what refinancing is. Right now, we're in ideal conditions to refinance mortgages. I mean, for starters, interest rates are at historically low levels, right? So both the fixed and the variable rates are just ridiculously low, right, Merav?
Yeah, absolutely. This is absolutely incredible, and we definitely want to take advantage of this. And also, property values, we've seen such a hike in 2020. So I think those two conditions definitely make it the ideal time to refinance and take advantage of getting some money out of your property at reasonable rates.
Okay, so let's talk about that. So why, house prices have gone up in value. How does that impact, obviously, the refinancing?
Well, obviously, when the government says that you can refinance up to 80% of the value of your property, the more the property goes up, the more money you can get out.
Right.
So, if your house was worth 400,000, 80% of that is 320,000. I just tested my math skills
There
there.
you go.
But if let's say a year later, it went up to 500,000, now suddenly you can get a mortgage of 400,000. So definitely that gives you a lot of borrowing power when the value of your property goes up. And if
Exactly.
you're doing also active appreciation, whereby you're renovating, you're improving physically the value of your property besides the market value, then we're talking even more capacity to get money out.
Yeah, I agree. I agree. And so let's talk a little bit about reasons why to actually look at refinancing. I mean, the basics is obviously home renovations. Okay, so we have a lot of people that are going to come in, they're going to see us, they're going to say, I'd like to build an extension, I'd like to build a deck, I want to repaint my house. So home renovations are a big thing. Many times people have actually done the renovations already and they've accumulated a ton of debt on lines of credit and things like that. And at a certain point in time, that also plays in. So, refinancing for debts. Sometimes the debts were used for good things like renos and buying investments, and other times the debts were not, right?
And if I could just go back to the renovations,
Mm-hmm.
what's interesting about that is that you're refinancing to get money for renovations, but then that money invested into your home will improve the value of your home, which in turn increases the value of your home, which basically now the mortgage that you have, the ratio versus the value is lower because you've just improved the value of your home, increased the value of your home. So I find that renovations are actually a good way to something good to invest in when you actually refinance your property.
Definitely, I agree. So, I'm 100% with you. I do want to add, I want to play devil's advocate here a little bit, and I want, talking about renovations. A lot of times, every time someone comes into my office, I get kind of the same, if you will. Everyone says the same thing. Okay, so when I ask them, how much do you think your house is worth? People are going to come back to me and they're going to say, my house, I believe it's worth this much. My neighbor sold for this much, usually a lower amount. And the reason why my house is worth more than them is because it's so much bigger. I have more land. I have this. I have that. It seems like I only get the people that have the bigger lands, as clients. That's not true. If I look in my neighborhood, and you ask me about my house compared to my neighbors, I'm always going to say that my house is better than my neighbors. And that's not necessarily true, but it's what we believe. Unfortunately, when you're doing renovations, the same thing goes in. So what we believe is going to actually add value to your house doesn't necessarily do what you think it's going to do. So I've had people come in and they say, I'm buying this house for $1 million. I'm putting in $600,000 of renovations, 500, 400, whatever, and it's going to be worth $2 million. You have to be really, really careful when you're refinancing for renovation purposes that you're not going to renovate your house out of the neighborhood, right?
Yeah, I definitely agree. So the main renovations that we definitely need to invest in is bathrooms, kitchens,
Exactly.
things like that. The roof, as you always say, it maintains the value. It does not increase the value; it maintains the value.
That's it.
So there's little things that you definitely should look into to make sure you're renovating the right things, and putting marble floors might not improve the value versus putting regular tiles. So definitely look into those things.
And just because you like a gold toilet bowl doesn't mean that the next person that's going to be buying your house is going to want a gold toilet bowl. And by the way, in case you're wondering who puts in a gold toilet bowl, I've seen it. Okay, I have not the toilet bowl itself because that's out of porcelain, but I've actually seen gold-plated toilet bowl seats. Okay, so you got to be really, really, really careful with the kind of renovations, the kind of investment that you're actually putting into your house. You got to make sure that you're doing things right. Now, one of the other reasons why people would be refinancing is obviously to purchase a vacation property, right? Or an investment property. So that's a big thing that's happening right now. People are flocking to the country. That could be a vacation property, or it could be that you want to refinance so that you can actually go out and buy a property in Florida, right? Invest in other vehicles as well. You want to buy stocks, bonds, RSPs, etc. That's also a really good thing. And actually, to add a little bit something extra to that, when you take money out of your mortgage for investment purposes, that portion, that mortgage, actually becomes tax deductible if it's done correctly.
So only the portion of your mortgage that you're going to use for investment purposes, that portion, even though it's on a principal residence, the interest that you pay on that mortgage is tax deductible.
Exactly.
That portion of
Yeah,
the
it's
mortgage.
got to be done right. You got to speak to your accountant and your tax lawyers or whatever. But that's exactly right. So the portion that's used for investment purposes will become the interest that you're paying becomes tax deductible. Now you can't take that money and buy RSPs with it because that's going to be double dipping, and you can't buy TFSAs. But anything that generates a return for you every year, you can write off that interest. You can also refinance your mortgage so that you can pay down high interest debts. Build cushions for rainy days. I hate that expression, but this is the reality. Help family members, get a lower interest rate. That would be a switch. Or just overall, maybe just improving your cash flow, right?
Yeah, I think that definitely paying off debts and improving cash flow is something we need to expand on after the break, Terry, because that's an important one.
Absolutely. When we come back, we're going to be looking at that, plus what kind of penalties we can face when breaking our mortgage midterm and how to decide if it's worth it.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
You're listening to The Real Estate Show, and today we're talking about taking advantage of the market and refinancing your mortgage. Feel free to call in with your questions by calling in to 514-790-0800, or you could text into 514-800. And don't forget to write your name in the text so that we can give you proper kudos when we get it. So before the break, Merav, we started talking about refinancing and whatnot, but let's talk about the elephant in the room. There's a penalty to pay when you break your mortgage before the end of the term. Is the cost worth the benefit? And that's the big question right now.
Yeah, I think it's an important point to address because a lot of people might be thinking, great, we want to refinance, but no, I can't do it. I have a term. I have I'm devoted to this bank for 5 years and it's impossible for me to do it. Well, believe it or not, it is possible. And all it is that you have to calculate the penalty. Sometimes you have to check that with your bank versus with your new broker or new bank. But once you have that number, you say, okay, now I'm going to calculate if it's worth it, what I'm going to get out of it, what kind of debts I'm going to pay off, what kind of result am I going to get from this refinance. And if the cost is worth the benefit, then definitely do it. Sometimes it could be small penalty. Sometimes even a large penalty makes sense, but definitely it's something that we need to calculate. And very often we surprise ourselves that yes, the cost is worth the benefit. So definitely we need to talk about it.
At the end of the day, it's dollars and cents, right? So if it makes sense to actually break the mortgage, you do. If it doesn't make sense to break it, you don't break it. I mean, it's as simple as that. I will add something else to this, and now I'm going to give myself and all other mortgage brokers a big pat on our backs, okay? Because part of the conversation that we have with our clients when we are setting up a mortgage for them is, what is the penalty going to be like when they actually break that mortgage? And a lot of times when you're going with, the big banks, you walk into to meet with like a mortgage specialist, and I'm doing air quotes here, for when I say mortgage specialist, that discussion is not there. They believe that all banks, all lenders are created equal and penalties are equal across the board. And there's truth to it, but there isn't. So all mortgages have penalties when you break the term. But how that penalty is calculated is very different between, let's say, a virtual lender or a lender that is only accessible through a broker and a big bank. And I'll give you a perfect example. I had a client recently. Actually, there was two clients, both with similar amortizations, similar mortgage amounts. Everything was the same, except one was with a traditional brick and mortar bank, and the other one was with a regular virtual lender that we had put them with a few years ago. The brick and mortar bank, they had a penalty of $41,000 to break that mortgage. Whereas the other lender, the other client, I should say, the lender, it was only about $10,000. So it's usually about a quarter less when it's done properly. And these are things that you have to really, really pay attention to when you're actually setting up those mortgages, when you're buying your house at first, or even when you're refinancing or switching lenders, so on and so forth. The other thing,
Yes, definitely. Sorry, I want to. I agree with you 1,000%. I find that there isn't enough discussion about what it takes to break this contract. Just like you wouldn't go into partnership, you wouldn't incorporate with someone and not figure out what it would take to break it. Same thing. You have a mortgage. You have to know what it takes to break it, and that discussion is not spoken about enough. And we try and make it a point really to always explain that to our customers so that they're aware that if ever push comes to shove, you need to break that mortgage. This is how the penalties are calculated.
There you go. And talking between even if when you're with the same lender, so let's say you're with a brick and mortar bank, not all mortgages within that lender are created equal as well. A variable rate mortgage will have a different penalty than a fixed rate mortgage. So a fixed rate mortgage, you're looking at the potential of 3 months of interest or an interest rate differential, whereas your variable rate is only going to come with a penalty that's going to be 3 months of interest. But yet again, I've also seen something different occur between bank to bank for variables. I've seen a bank charge 6 months of interest on a variable rate mortgage. I've seen variable rate mortgages with restrictions on them, which means that if you break that variable rate, which typically would come with a 3-month the penalty is equal to 2.7% of the amount that's owed multiplied by number of years sometimes. So you have to be really, really careful when you're setting up your redefined print, and don't chase rates from the get-go, because a lot of times what happens is we're chasing an interest rate, and unfortunately when we're chasing an interest rate, what ends up happening, we end up hitting a wall. We were chasing something that didn't necessarily work out well.
Cheap is expensive.
Cheap, yeah. My mom has this. Actually, all Greeks have this great expression, which I'm going to say in Greek. It's "ta ftinata tronikotes," which basically means, the cheap things are eaten by the chickens, right? So, which is true.
Thank you. Yeah.
Sorry, I had to say it in Greek. I've heard that expression my whole life.
but it's true.
Yeah.
Yeah. So, what about debt repayment? I find we've done a lot of debt consolidations, gather all those high interest loans and pay them off and improve cash flow dramatically, even if it entailed a penalty. The monthly savings was so great that it was definitely a no brainer. Can we
Exactly.
cover that a little bit, Terry?
Yeah. So sometimes, like giving the example of that client that had a $41,000 penalty, the money for the refinance was actually going. A part of it was going to do investments, okay? And when we did the calculations, it worked. And it's the same thing when we're talking about debts. So every month, let's say you're spending X amount of dollars on, right? If you do a refinance, and we incorporate those debts into the mortgage, all of a sudden your monthly payments are going to drop drastically, right? When you have that drop occur, what you do with that savings will determine whether or not that refinance that you did made sense, right? So it's black and white. I mean, there's no mystery to it. I'm spending X amount right now. I'm going to be spending X amount after I do this. This is the savings monthly multiplied by numbers. Does this make sense to do versus the penalty that I'm going to be paying? You're paying $5,000 of penalty. You're saving $10,000. Do it. You're getting a penalty of $10,000. You're saving $5,000. Don't do it. If it's a break even, it's debatable. Okay. But the most important thing to remember is what you do with that money will determine whether or not what you did made sense or it's like a complete and utter fail. And we've seen that happen a few times with clients, right? That came in and they had fails. I mean, it didn't work. So, and we actually opted for them not to do the refinance.
Yeah, and also what we're seeing a lot, seeing as young people have takes them longer to save up
You
their down
sound
payment.
like an old lady when you say that.
I'm sorry.
These young folks.
These younglings. No, but I'm saying like a young couple, it takes years to save up that down payment. So we do
Sure.
see a
Yeah.
lot of parents refinance and give that $30,000 or lend it in order to help their children. The parents, their property went up in value. A
Yep.
lot of them have no mortgages or very small mortgages. And we definitely encourage that. Why not become a homeowner earlier than what you're supposed to with the help of your parents?
100%. I've seen grandparents take reverse mortgages to help their grandchildren. I've seen parents do refinances to help their children. Absolutely, I agree 1,000%. And I don't think that there's anything wrong with it. Again, it's not something that's easily quantifiable, but it is something that is doable and it gets done all the time. Up next, we're going to have a deeper look at how different it is to qualify for a mortgage today versus 3 or 4 years ago.
You're listening to The Real Estate Show with your real estate and mortgaging team, Terry Kilakos and Merav Marciano on CJAD 800.
Thanks for tuning in. In today's discussion about refinancing your mortgage, you're listening to The Real Estate Show. And today we've been talking a lot about, refinancing and kind of restructuring things. Let's talk a little bit more, Merav, okay? Let's talk about mortgages that were set up a number of years ago, because a lot of times people, they'll come into the office and they're going to say, hey, you know what? I qualified for this mortgage 5 years ago, so I can qualify for it. No problem right now.
Yeah, we see that a lot. And in their defense, they're not keeping track of the mortgage rules and how the government is changing things. And we've seen tail end of 2016 all the way to January 2018, a whole bunch of changes have been implemented. January 2018 was the main one where the stress test was implemented full force. And that hurt quite a bit with respect to the borrowing power of consumers. So, Terry, if you could just go over the details of how the stress test works, because that one is important for people to understand. If they got their mortgage before January 2018, the way to qualify for a mortgage is definitely different.
So when we're looking at mortgages that were set up, a number of years ago, they were very different than today. So today, for everyone that listens to the show, that, I'm a very huge supporter of, the stress test. So the stress test was put in place a few years ago, which basically means, to summarize it and really kind of quickly, just because your interest rate on your mortgage is, let's say, 2%, it doesn't mean that that's the rate that the bank is going to be using to actually qualify your mortgage. So the bank that's actually the rate that's actually being used to qualify the mortgage is the Bank of Canada rate. And the Bank of Canada rate is actually 4.79 currently. So you might be receiving 1.5% or 2% on your mortgage, but the rate that's actually being used to qualify you is much higher, which means that people's buying capacity has drastically dropped because of that one move that the Bank of Canada did. One of the reasons why they did it is because they didn't want people to kind of use their homes as ATMs. But again, I think that it's, the government, when they put this in place, they said rates are going to go up. We got to protect people. Rates haven't gone up. They've actually gone down. And even when they start to go up, we're going to see them going up, but they're going to go up gradually. So I don't think that in 5 years, we're going to see rates reach 5%. Maybe they will. Maybe they won't. Okay. So that's the basics of the stress test. But some of the other changes, previous to that, you used to be able to, refinance your mortgage higher than 80%. You used to be able to actually have amortizations that would go to 35 and 40 years. These are all changes that have, these are all things that have been slowly removed over the years since 2008, right?
And the recent one, Terry, CMHC changing the indebtment ratios and the other insurers not following suit. Can we go over that? Because that also affects the borrowing power.
Absolutely. So last year, what we actually saw was CMHC came in and they said, we're going to lower. Okay, so if you guys remember my financing triangle, right? So there's three things that you need when you're qualifying for a mortgage: credit, income, equity. On the income side, there's two ratios. One's called the GDS ratio. The other one's called the TDS. The GDS ratio says that no more than 39% of your gross annual income can go to paying debts that are specifically related to the property that you're buying. The other one says that no more than 44% of your gross annual income can go to paying those debts plus everything else. What CMHC did last year is they lowered those numbers from 39.44 to 35. Oh, excuse me. Actually, I think it was 32.39. They brought it down to, if you remember.
I
or
don't
was
remember.
it 35.42? Anyways, they lowered them. And when they ended up doing that, they basically, all the other insurers, because there's three insurers in Canada, there's CMHC, Genworth, and Canada Guarantee, they all kind of went in and they said, what the hell are you guys doing? And they said, we are not following suit with this. Adding this on top of the fact that you have the stress test is completely and utterly unacceptable. So nobody else followed suit. They didn't lower it. So for us, because we're able to use all the different insurers, we have the ability to get the proper numbers. But I have clients that come and see me, and actually we had a caller last week who said, I went to my bank and my bank gave me a really low pre-approval, and then when we look at it, it actually comes in higher because we're using the other two insurers, whereas not that person in particular, but people will go to their bank and that they might be using the guidelines of CMHC, and then all of a sudden, if you're using the guidelines of CMHC, now all of a sudden you're qualifying for less.
And I've got those numbers in front of me, Terry. They dropped it from 39.44 to 35.42.
There you go. Exactly.
So that definitely, again, reduces your borrowing power.
Yeah. By the way, those numbers are typically reserved for people that, bank policies sometimes will be put in place. And the bank might have a policy where they won't exceed 35.42 if your credit score, interestingly enough, is below a certain amount. So if your credit score is on the weaker side, they might say, we're going to cap it out at 35.42. But then you come to a broker and the broker says, well, with your credit score being where it is, we could still go to 3944 with this specific bank, not necessarily that one.
So all in all, you would say right now is the best time to refinance. Rates are low, values are high. It's a time to build that cushion. It's a time maybe to renovate your home if you were thinking about it. Help your children buy a property before it continues to go up. So today, definitely, you would say 2021 is the right time to refinance.
It is, and the best time of the year to actually do it is actually right now. So in the first couple of months of the year is the key time to actually look at refinancing. One of the main reasons is you're actually able to take out a little bit more out of your mortgage and use that money and put it towards your RSPs. And then by putting it into your RSPs, it's going to trigger a nice tax refund for you, triggers a nice tax refund for you. Now you get money back, and now you're starting to build up those cushions, right? And I'm all about double dipping. So I'm all about making sure that we're putting money away and we're doing the improvements, paying off debt, everything, all of the above. And I cut you off. I saw you were about to say something.
No, not at all, not at all. I like that plan actually. Pull out some money, pay off some debts, invest the rest, put it in RSPs, get a tax refund, and start that cushion all over again.
Absolutely. And nothing actually, you know what, Merav, nothing stops you from, let's say your debt load is not anything crazy, and you can, let's say you owe $10,000 and you're thinking about getting some money in there into your investments, into your RSP. If you would take out $25,000, $30,000 out of your home and you put it, let's say, into an investment vehicle, so let's say an RSP, that, provided obviously that you've paid withholding taxes, and please verify with your accountant. So I don't want a whole bunch of people kind of reaching out to me saying, you said you could do this. Make sure that it's actually doable. You take the money, you put it into your RSP. That 25 to 30,000 should trigger a tax refund of about $9,000 to $10,000 back. You get that tax refund, you pay off your debts. So you're basically paying off your debts with the fruits of your investments. Make sense?
Love it. Love it.
We've run out of real estate. Merav, if people want to reach us, they can call us at
514-680-4674 at the office or online at www.nordest.ca.
Till next week, everyone. Have a blessed week. Love you all.